While interest rate cuts remain on the sidelines, market performance continues its roller coaster ride. I'm Mark Kinney, Chief Investment Officer at Newport Private Wealth, with your first quarter investment update. The equity market rally that began in late October continued through the quarter as investor enthusiasm remained high. This was fueled by economic growth in the U.S., a noticeable slowdown in inflation, and strong corporate earnings. By the end of March, many indices had reached levels we last saw in late 2021. Unfortunately, the bond market did not fare as well. The strong tailwind that propelled bonds at the end of 2023 fizzled as optimism about the pace and frequency of interest rate cuts in 2024 waned. In this environment, Newport remained calm and steadfast, staying true to our strategy. Our results reflected the soundness of this approach. The 5 Newport mandates posted positive returns in the first quarter, with performance ranging from 2.23% to 3.93%. This supports our conviction that taking a long-term investment view is the most effective way to protect your wealth in unpredictable conditions. This can be seen in the Newport Balance Fund, which has outperformed its benchmark for the past 3 years by more than 23%, with 65% less volatility. While it's too early to use our performance as a predictor for the entirety of 2024, we believe we are well positioned for whatever the market may bring in the months ahead. The investment committee was busy in the quarter, making new investment decisions totaling $110 million. We capitalized on the first quarter market weakness in the bond market and added to our holdings. 3 investments amounting to $23 million were added to one of our Toronto-based managers. This brings our total bond allocations since early 2023 to $145 million. With current yields still appealing, we are eager to increase our exposure and duration ahead of interest rate cuts. To diversify our yield investments, we allocate funds to alternative assets like private debt, mortgages, and infrastructure. These investments serve as both steady sources of income and buffers against market volatility. During a relatively quiet quarter, we made a modest investment with one of our multifamily residential managers. It's not unusual for allocations to private investments to ebb and flow given the extensive and time-intensive due diligence we undertake. We continue to evaluate opportunities in private asset classes shaped by our outlook and current valuations. Similar to the last quarter in 2023, investments in the first quarter were concentrated on public asset classes. In a robust economic climate, U.S. equity markets showed strong performance in the first quarter. While AI-driven tech companies continued to lead the charge, there have been some stumbles. The Magnificent Seven may well become 5, as Apple and Tesla have recently fallen out of favor with investors. We're beginning to see broader market participation, which is favorable for stability. This also leads to opportunities. We invested an additional $86 million in public equities as market conditions improved. The investment follows a $75 million allocation in the fourth quarter, which resumed after a pause during the September and October 2023 sell-off. Over the past 6 months, our total investment of $160 million underscores our capacity for tactical opportunism, leading to increased equity allocations across our 5 mandates. Our experienced specialist managers are well versed in the market variability we have been experiencing in the last cycle. They are rational investors who share our philosophy of investing in quality companies, trading at attractive prices that they believe are positioned for long-term success. We will continue to work with them to take advantage of market dislocations as they arise. As Warren Buffett said, "Only when you combine sound intellect with emotional discipline do you get rational behavior." While actively investing, we've protected ourselves against a shift in market conditions. Our 5 mandates maintain cash balances between 7 and 10%, and our equity allocations remain below upper target limits. This positioning allows us the flexibility to capitalize on opportunities should the markets pull back. Given that our cash holdings are currently yielding over 5%, the cost of maintaining this flexibility is minimal. What's next for our investments? As the second quarter unfolds, the economy is stronger than expected, and we've avoided a recession so far. Although inflation has become sticky and rate cuts appear to be delayed until June, the market remains optimistic. Initially, investors anticipated up to 5 rate cuts this year. Now we're seeing expectations centering on just 3 or fewer. We believe Canada could cut rates ahead of the US, which will be a welcome relief to households. The recent moves in our portfolio are a response to the continued instability of both these key economic indicators. High interest rates continue to have an impact on various asset classes, especially bonds. The strengthening US dollar also has implications for growth assets. As we adjust our portfolio in the months ahead, our goal is to position the portfolio to withstand market pressures and capitalize on growth opportunities. February's inflation report was notable as it marked the first instance since early 2021 that the Consumer Price Index has remained within the Bank of Canada's target range of 1 to 3% for 2 consecutive months. Reduced borrowing costs would stimulate the economy and support growth assets. The Canadian bond market would also receive a price boost. This would play out positively for Newport's strategy, considering our significant bond investments over the past 15 months. We're watching the performance of the credit markets, as the reversal in yields has provided an opportunity to add more capital to the bond market. Market pullbacks signal potential buying opportunities, and we continue to add opportunistically to our holdings. Equity markets anticipate future conditions, and recent performance globally have largely accounted for a more favorable rate environment. For central bankers to feel comfortable initiating rate cuts, inflation must stabilize at current levels and ultimately continue to trend lower. The longer this takes to happen, the greater the risk of deviating from an economic soft landing scenario. Our investment strategy is bolstered by diversification across 12 public and private asset classes, protecting us against the type of volatility that affects portfolios limited to stocks and bonds. It's essential to stay adaptable while sticking to a long-term plan. Protecting your capital over time is a path we never veer from. We look forward to providing more updates and insights as the year progresses. We are appreciative of your trust and confidence in us and are honored to safeguard your wealth. From all of us at Newport, have a safe and enjoyable summer.